Hey guys, welcome to another Trade Genius podcast. Guys, the bond market is mad at the Fed, and that's never a good thing. We're going to talk about what all that means, and let's dive in.
Trade Genius.
All right, Bob. So, really interesting situation here in the bond market and the Fed. Usually they're in agreement. Fed raises rates, yields typically also rise, and vice versa. Now it's like totally divergent. And you had shown me a couple of charts that I think kind of explains what's going on. It's not a new phenomenon; it's been building, and I think it's just coming to a head here.
So we have a situation here where Janet Yellen, she's got to be the worst globalist plant trader they ever could have put into this into the American Fed and our Treasury. Talk about a spy, for the globalists. I mean, she destroyed the Treasury. Then she goes to the Fed. Then she goes back to the Treasury, and then she does this bill issuance thing. This is what they call a poison pill fill. Okay, so their idea was we're going to try to overstimulate the economy so we can get reelected, and then we figured the next election we'll be able to control anything we want to control. But they lost the election, and now it's become a poison pill for Trump. And what's happening here is that you can't and you should not do this many bill issuances at one time.
Nope.
The percentages were way out of whack on them.
Yep.
And because the rollover gets to the point where people may not want them at all, and the banks won't be able to take them, and the Fed won't be able to absorb them, and then you get failed bond auctions, which is almost an impossibility, but this could do it. However, what they're going to have to do now is they're going to have to buy Treasury bonds and notes instead of bills. And I think it ties into this next chart. And I know you have an alternate theory, which I also agree with, because I think one creates the other, is that the Fed's been reducing interest rates on the short end, but the long end is blowing back the other way. And I think it's because they know that the Treasury is going to have to sell longer dated bonds, and they're simply front running them. And if by front running them, it creates that situation I'll let you explain in terms of inflation.
Yeah, basically, if you look at what the bond market is doing, right, and the bond market to me always the smartest guys in the room, right, are the bond vigilantes. And what they're basically saying is that they don't agree with the Fed in their plan to reduce rates into next year. I think they are concerned with inflation, and you'd probably see a more favorable response if the Fed was, even though he came out and was seemingly hawkish, the fact that they were still talking about rate cuts well into the back end of 2025 is actually kind of dovish. And I think this is the bond market's way of saying they disagree. And I kind of agree. I think that you're going to at some point be told that 3% inflation is going to be the new target, or 3 to 4%. They're talking up a storm about 2%. And I think that's because they want to get at least core PCE down, because they will need to get to another round of QE if we do roll over in this market in the economy. I think that's what's at play, Bob. But the bond market is not happy, and Jerome is probably the first Fed chairman that's really seen this kind of divergence. So it is pretty significant. But I do agree with you as well that it also plays into where that long end is going to get issued, because this bill issuance is crazy high, right? I mean, if you look at the long-term trend line, we should be down, around the 200 area there on that index, and we're simply just not. And that's why I think they staved off a recession, right? Because as you expend a bunch of short-term bill issuance, bills are the short term, right? They're not coupons, they're not bonds. Bills are just very short term. They're the equivalent of dollars when it comes to collateral, right? And then that turns into leverage. So they were able to, promote or perpetuate this game where I thought we would be into a recession in 2024. But when the bill issuance started going off and that was being pointed out, then I was like, well, she's probably bought this market another 8 to 12 months. And in reality, that's pretty much what's happened. Now, why don't they just keep doing that and prop the market up? Because you're not going to make your interest payments at that rate. And then you're going to blow up the bond market, like you were saying before when we were talking, Bob. You can't have that, right? At the end of the day, the very last thing you have to save is the bond market. And so I think that's really what's going to be the issue. So bill issuance will die off, and I think the long end is coming. And that isn't necessarily positive for stocks or crypto or any risk on assets. And I think that's why, too, you have to brace for 2025 as being pretty rocky outside of just the economy rolling over.
Well, and ironically, as these interest rates keep rising, it kind of supports oil and it kind of supports Bitcoin. I know you were talking in the room about the dollar today too. Those are hedges against higher interest rates. When they do get control of the interest rate on the long bond by issuing and buying them, absolutely it's going to affect oil. It's going to affect Bitcoin. It's going to affect the stock market, and I think that's where our market sell-off is going to come from, Phil. Once they have to absorb these bills back into a normal bond, portfolio, it's just going to suck the liquidity right out of the room because, like you said, collateral goes away. When collateral goes away, guess what? Remember in 2008, if you had a home equity line of credit that you weren't using, they sucked it up and took it away from you. And that's what's going to happen here on a massive scale once again. And it's not going to be fun. And right now, with these interest rates high like this, nobody can really get a loan. So
Right.
it gets politically unpalatable. And so we're going to see some major changes here. And Yellen just walks away from this thing and she's going to sit in another room, and start sniping at Trump when she's the one that caused all these problems.
Yeah, and speaking of liquidity, we don't show this chart that often, for the subscribers and things like that get it. But, it's worthy of noting that the liquidity hasn't really come back. I've highlighted Q4 here, right? So this is in the last fourth quarters. You've seen we usually get a liquidity build into the end of the year. We're not seeing that really here. In fact, liquidity is pulled back sharply here. So if we do see new highs, and we may see a surge come in after the first, but the point being is that I think why we're not seeing just this huge move up into the year end and why things are kind of struggling here a little bit, we had this pullback and dip, is simply because the net liquidity is just not present. So it's just something to keep an eye on. I think it's going to continue. Remember, when we topped out into the end of 2021 into 2022, liquidity took a nosedive. I mean, just absolutely took a nosedive. And that's what we got. I think that's what's setting up. And I think that's also going to play a part into, our scenarios for 2025. Ultimately, though, I do think that does drive yields down, but once that TLT trade takes off.
Well, remember, you call it the uninversion trade, right? So there's a thing where when that breaks like that, the market has no choice but to roll over. I think it's 100% correlation. So I look at Santa, that Christmas Eve looked like Santa came to town, and then come the day after Christmas, the Grinch showed up. So, I think ultimately we still should rise higher here. I think it might have just been a little bit of a reaction to such a big day on Tuesday. But we'll find out tomorrow. If tomorrow we don't get an update, Phil, then, the bearish scenario continues to haunt me. So we just have to remain cautious. I'd rather miss something on the upside here than to get punished on the downside. So I continue to just add to my hedges and my defensive positioning and try to day trade myself on these days where the market's long, because I just think we're really closing in on the end. My personal view.
Yeah, and to your point too about the yield curve, we talk about this a lot. Recession typically triggers around the 0.6 historically, and if you look, we have our implied rate of appreciation kind of based on past cycles, and we're starting to get to that point where we should start seeing this next leg up, which implies the yield curve should hit our threshold over the next few weeks, and then you can see below what to expect in the market if we do get that. So really important time period here, and maybe we do hold up into January a little bit, but I think after the inauguration you have to be very, very, very careful now.
I agree. Hey guys, if you want to trade with us, tradelikeagenius.com. We got our year-end special still running, and take advantage of it. Come January, we're bumping the price to pay the extra bills that Janet Yellen's given us. So we'll catch you guys hopefully tomorrow. Enjoy your Christmas return day. See you later.
Trade Genius.